if you want to long-term compete with companies like Wise or Revolut or Airwallex, it's not possible unless you own the infrastructure, unless you internalize the liquidity flows, or own really great relationship with liquidity providers. Eventually, you should be the liquidity provider yourself.
That's Rob Sargsian, co-founder and CEO of Do, a stablecoin-first payments network that's reshaping cross-border transactions and liquidity management for businesses. With a background at Bolt and Revolut, Rob has seen firsthand the inefficiencies of global payments, especially in emerging markets where costs can reach double-digit percentages per transaction. In this episode, we dive into how Do is leveraging stablecoins to bypass traditional banking frictions, reduce costs, and enable real-time cross-border payments.
Season 3 of Stableminded is powered by Defense, the leading multi-chain wallet platform helping fintechs, banks, and enterprises manage digital assets securely. More than 130 global clients secure over $1 billion in monthly volumes through Defense. Manage governance and compliance, automate workflows for approvals, and unify your APIs, all within a platform that has a perfect security record. Access a broad network of ecosystem integrations. From compliance tools like Chainalysis to exchanges like Coinbase, Defense integrates seamlessly with all the tools you need. This season, we sit down with the co-founders of Defense to dive deeper.
All right, Rob, thank you so much for joining. How's it going?
Thanks for inviting. No, all great. Happy to be here.
I've been following Do ever since you guys launched that really slick website. I think for me, when I think about the coolest websites in the game, I think about you guys. Highly recommend someone to go and check it out. It's just, I don't know, I love the way it looks and feels. And I don't know a ton about Do Network, so I'm really excited to dive into it today. Why don't we start with your name, the role at the company, and then a high level of what that company does and what you're building.
Sure, yeah. Thanks for this. I'm Rob. I'm one of the co-founders and the CEO at Do. What Do does is essentially we're building a payment platform that is stablecoin first. So we're leveraging stablecoins and blockchain infrastructure to enable faster, cheaper, and more accessible payments across the world. We're connecting to local payment rails, mostly real-time payment networks, and we're connecting to all the major blockchains and stablecoin markets to be able to provide that seamless movement of funds between fiat currencies or between fiat and stablecoins. That's what pretty much we are, and we're building sort of both on the infrastructure side and the application layer. Happy to dive into it later on this.
Awesome. I always like to start with a little bit of background. And for you personally, when did this problem become a problem for you to solve? When did you realize that payments needed an update? And how did you just get involved with this business model to begin with?
Yeah, I would say it came to me gradually, because I think first time I faced problems with cross-border payments was back when I was at Bolt. Bolt is this European ride-hailing company, large multi-billion-dollar company right now, usually number one in some of the Eastern European markets, number one in some of the African markets, in some of the Western, European markets, number two after Uber. And I joined Bolt back in 2019, I think. And one of the problems I saw is that when we had to pay to drivers or collect payments from the riders, cost of the end-to-end transaction from collecting payment from the rider and then paying out to the driver, in some cases was around 11% on the ticket, right? And the reason there were a lot of reasons for that. One of it was that you were doing double FX, because let's say you are a European merchant like Bolt is, you're collecting payment from a rider in Ukraine, and then you have to convert it from Ukrainian hryvnia to the euros, and then back to Ukrainian hryvnia to pay out to the driver in the same market. Unless you have a local payment setup, that can be quite expensive. And the same thing happened across a lot of markets in Africa. We've seen this. We've seen in some of the markets in Eastern Europe, and that was the first time I realized that global payments. In global payments, there's a lot of friction, and it can be quite expensive. And then that's when I kind of started researching more about the payment space. Read the book by D. Hawk called One from Many about Visa, how Visa started. It was just interesting for me to understand what could be a better solution for global payments. And that kind of brought me to Revolut. I had an offer to join Revolut shortly after that. My initial thought was that companies like Revolut and Wise will solve this eventually. So there will be essentially new payment networks built by this giant fintechs that would be closed loop, but that would allow instant payments across markets in different currencies, and will essentially resolve this. So you will never have this problem. But over time, as I worked at Revolut, I realized that as these companies become bigger, there's multiple things happen. One is that they start to offload some of the risk, which creates additional frictions for especially markets where, like high risk markets or capital controlled markets, like, especially in emerging markets, right? That's one thing that happens. Second thing, a lot of these players, they are super, like they're very much connected to the traditional rails. They build on traditional rails. They still have the same frictions of correspondent bank relationship, of all this compliance, I would say frictions and things that sort of slow down the process of settlement, RFIs and AML requirements, risk of high risk industries or high risk, jurisdictions that essentially stop some of the payments to go through. I realized that we need something else, right? We can't just rely on centralized players that actually underneath use traditional bank rails and correspondent bank. And as a sort of big part of my focus at Revolut was crypto. And I saw that crypto was becoming more scalable, blockchains getting higher TPS, lower cost per transaction. We saw that there's more clarity on the regulatory side with MiCA coming. And then there was more and more institutional contribution to the market. So there were more and more liquidity, especially in stablecoin space. So it was very clear that there needs to be a company on the intersection of payments and blockchains. And that's what kind of brought me to that. I realized, okay, this is the solution because it's a neutral payment system that is fully interoperable. Anybody can take part in it. Anybody can become a liquidity provider. Anybody can essentially help make it smoother and more accessible and hence cheaper and faster, right? So that was sort of the initial thought. And that's how we started. And then after that, as we started speaking to our potential customers in emerging market, we realized how big that problem is. And it's not just for, on-demand platforms like Uber or Bolt, but it's actually for a lot of different industries. There is a huge cost of running international payments or collections, right? That's sort of how we realized the problem.
Yeah. It's amazing. What was the experience for you like? I'd love to dive a bit deeper into your time at Revolut. I feel like Revolut was is still such an innovator within crypto products and rolling out crypto forward things at scale. One of the most, what started as traditional payments bringing in Web3 functionality with a very, very large user base versus something like a Coinbase, which started completely crypto native. And what was that like for you being within an organization that traditionally was built with traditional financial rails and then working within that context to enable on-chain functionality? I feel like right now, a lot of people listening to this might be in a similar boat where they're like working at maybe a more traditional financial technology player or neobank or non-native crypto firm. How did you operate that? Any advice for people in that same position?
Yeah. Revolut has been amazing for me back then. And I love working at probably. For me, it's one of the best fintechs you could work at, especially in Europe. It's probably one of the best fintechs in Europe, if not the best. And even though Revolut was already a big company when I joined, I think it was over $30 billion. I think it got to $30 billion valuation pretty much the same year I joined, probably. You still could grow fast within the company. You had exposure to, CEO and top management. You could, work with them. You could take on new projects that are important and significant for the company. There was a lot of interest for new bets and new startups within the company, essentially. That's what I love. Essentially, for me, it's much more interesting to work on a new thing rather than optimizing a bigger thing. And that's what I loved about Revolut, that even though it's a big company, it continued to innovate and add new products every year, like, 10, 20 new mini products within the app, which actually all of which have their fully fledged competitor out, right? Like there's if you're building, I don't know, if you like building payroll solution within Revolut, there's somebody else building just focused on payroll. This is what's amazing about Revolut is that you're trying to build a super app in Europe that, nobody ever done. And I think it's like the first company who is going to succeed with it, right? So it was amazing there. And when it comes to crypto, I think Revolut was super smart and maybe in some ways lucky to get into crypto very early. I think the first buy and sell functionality was introduced back in 2017, if I'm not wrong. And that was like super early, and it was a pretty big risk for somebody like Revolut to take on. But I think it was a great thing to do back then, and I think it played off pretty well. However, as any company, you always face things that slow you down, and over time, as Revolut has been trying to get a banking license, and eventually they received it. We saw more and more challenge in pushing for more risky products. For instance, back when I was there, one of the ideas I was scoping out to work on was stablecoins, right? Issuing stablecoins. I guess there were a few reasons why Revolut didn't do it back then. One of them was that maybe the business model wasn't that fruitful like it is today, because the interest rates were not as high, right? The interest rate we were in a zero interest rate environment back in 2022, right?
Okay.
And that was one of the things. Now things changed, and with 5% interest, on T-bills, it becomes a pretty good business model. Other things were like wallets, etc. And it was super hard to push this with the internal compliance, because your company is becoming more and more risk averse, I think. But still, even with that, I think Revolut is introducing new products every year. It just takes more time because you need to get your compliance comfortable. You need to get the regulator comfortable with it. It's not a small startup launching this product, right? It's a big company with tens of millions of clients, and that kind of slows you down a bit. So I guess it's about the will, right? Like if we're still at Revolut or at any fintech, it's all about the will, right? You need to push hard internally to prioritize your product. It's very similar when you're in a big company like Revolut. Like prioritizing your project is very similar as to how you prioritize your project externally, right? Like let's say you're building a startup and you need to prioritize a bank to onboard you or a partner to onboard you, right? To work with you. You need to build that urgency. You need to build the kind of reasoning why your project needs to be prioritized rather than other like dozens of projects within the company. It's about the will. It's about pretty much trying to figure out why and how you can make more money for the company. Same like how would you make more money for your partner, right? That's pretty much what I would suggest.
Would you recommend for someone who's like you, entrepreneurially minded and likes the idea of starting their own business one day and founding something, looking back on that experience, working at a larger firm like that, would you say that is a very, very promising strategy, like starting at this big company, getting those reps and getting that experience, and then really doing what you're doing now? Was that something you were intentional about? Like, did you know that when you were entering that season of life just a few years back, you eventually wanted to start your own thing?
I would say probably yes. So in my case, I was certain that at some point, sooner or later, I will start a company. I had a previous experience founding a company before Bolt and Revolut. And for me, I think it was a season for me to learn a bit more about how successful tech companies are built and scaled. However, I would say that if you have an idea and if you have a problem that you care about, don't wait. Don't go work at a tech company or at a big startup to then, leave it and start your own. Like if you already know what you want to do, the earlier you start, the better. That's what I think. Honestly, I think that domain knowledge is usually overrated, and I still think like that. And you learn most of the things you learn on the job, right? As you start building stuff, as you start encountering issues, or you just talk to customers, or you talk to people in the industry, and you learn much faster in your own startup rather than at a company. Or at least I would say within a time frame of a couple of years within your startup, you will learn more. Maybe like first few months, you can learn faster in a big company because you get in there and then there's a lot of information and a lot of people. You can just get briefed by everybody, like how things work, etc. The first 6 months, it's a pretty steep curve, right? Over time, I think startups, you always learn. Every single week, I learn something new, right? And so I would encourage people to just start something if they believe they found like a work of their lifetime or something that they really truly care about, regardless of where they are, like, or how old they are, etc. I would like really start it straight away. I wouldn't really wait or like strategize it into, hey, let me just first get into a fintech company and then maybe I'll learn more there and then I will, spin off into my own startup.
Yeah, it's awesome. Okay, so let's dive into what you're building today a little bit more. You gave us a high level overview in your introduction. Let's just go back to that idea of like helping people, especially people who are focused on stablecoins and stablecoin infrastructure. How should they think about really the core technology that you're building here? Like, what would you say really the thing that you find is the most differentiated or competitive or core technology that you and your team are spending most of your time trying to build out? Would love to dive into that a little bit. And then, we can kind of navigate where to go after that. Be curious.
Yeah, sure. First, I do believe that a lot of this tech is going to be commoditized over time, right? So we'll see more and more fintechs tapping into stablecoins, and a lot of them will build this infrastructure in-house. And I do think that companies like Klarna, Revolut, and maybe similar ones, maybe Wise at some point as well, will most likely build this stuff in-house. And the reason why they would do this is if you look at all these three companies I mentioned, all of them have their the core ledger or the core banking built internally as well. They would never delegate that to any infrastructure provider, right? So they built it usually themselves. And I think the same thing is going to happen with with the stablecoin as well, right? So I don't think that there is a sort of a secret sauce or anything in the stablecoin payment itself, right? I think where the modes are, and they're going to continue to be, is in two things. One is bank relationship when it comes to, this whole kind of building the stablecoin to fiat network, right? The thing that we're building. One is the banking relationship, like having direct relationship with banks across markets is valuable. This is what the business model of Wise have been, right? All the time is building bank relationship everywhere, having bank accounts, correspondent accounts. Second thing is, of course, which comes alongside with this one, is the regulatory mode, essentially having licenses in this market, having regulatory framework, compliance, and AML framework that works in each of these markets adds a moat. And we sort of bet on that. And we are building out our licensing and local infrastructure, local banking relationship, wherever we launch, right? And we realized that only last year, right? Like our initial idea was also, let's just connect to tap into on off-ramp providers everywhere and just build an aggregation layer on top. We realized it doesn't work. You actually have to own relationship with banks. You need to have licenses. You need to have regulatory framework everywhere. And you need to build that infrastructure yourself. As I would say, like on the payment side of things, right? It is important. On the blockchain side of things, it's a bit more flexible. Like you can leverage partners like DFNS or, Fireblocks or, there's a bunch of others that you can use, right? Or you can build it in-house. We have a hybrid model. So we use, we use DFNS for the security part of it, essentially generating the keys and signing stuff. But a lot of the interaction with the blockchain is our own proprietary tech. So we have our own indexer. So we index all the blockchains that we work with ourselves. We have our own blockchain monitor. We have our own real layer that broadcasts the transaction and builds up the contracts and the signature that you need to sign as a client. We essentially have our own layer of infrastructure that works cross-chain, direct integration with Circle, CCTP. We have integration with, Tron bridges and liquidity providers for on-chain transactions and DEXs, etc. We build that stuff internally ourselves. And that was important for us to sort of be super flexible in adding new primitives on-chain if we need to. If we want to add a yield-bearing accounts, we can add it within a week or two. If you want to add Aave or Morpho or any DeFi protocol and embed it into our product, we can do it pretty fast. because we own the infrastructure on the blockchain part as well. Or we want to add any new token, we don't need to essentially think about whether Fireblocks or somebody supports that blockchain or that token. We can actually build it ourselves. So there's some mode, but over time, again, that part is also going to be commoditized, and there's going to be less value in there. And then finally, I would say there is value in just providing a product that can be used by customers, right, end to end. And that's what we're trying to do. So we not only building that underlying infrastructure and payment network, but also building the application layer on top of it. So we're building our web application, mobile apps, APIs, so that we can serve end clients. And I think over time, owning the relationship with the client is going to be more and more important. And again, here you have different strategies, different providers, different companies have different strategies. Our strategy is to verticalize and essentially have both infrastructure layer and application layer proprietary, right? And that's what we're doing. Look at Wise. Essentially, we sort of looked at Wise, looked at Revolut, and saw that these guys are building all the infrastructure in-house. That's one thing. These guys are owning the relationship with the client as well. That's what we're trying to do, doing both essentially the app and the infra.
It's amazing. There's so much there that could be unpacked. Tell me specifically when you say, it sounds like when you started off, you attempted to go down this route, which I think many startups right now are considering doing or actively doing, where they are doing this orchestrate aggregation approach, where they're trying to maybe service those larger fintechs like the Wises of the world with that model. You, from what you just said, sounds like you tried to do that. You realized that was not the right strategy. Tell us more about that. What did you realize there that made you do what you're doing now, which sounds like is very focused on this regulatory focus and owning the customer relationship in that?
Yeah. So when we started around 2 years ago, right, our original idea was, okay, let's just build the tech side of things. Let's build the orchestration layer on top of this payment service providers. And the hypothesis was that in every market, you have an off-ramp provider that can give you a good rate for the FX. They can give you a good rate for the off-ramp part, and you can just aggregate them and then still provide a good solution to your end client. And as we started looking into providers like this in different markets, we realized two things. One, there is a misalignment in terms of AML, KYC, essentially, right? So every single provider, they have their own KYC provider, their own AML policies and procedures and transaction screening, etc. So it is super hard to harmonize all of that under one orchestration, especially if you're not touching the funds flow, if you're not taking responsibility for the compliance. It's super hard to harmonize. Right? That's one problem. I guess this was the first problem we saw, but we first thought, okay, this is probably solvable. It's probably going to take a bit more time, but you can harmonize this, right? You can probably push some of the providers to, have more standardized ways of collecting data on a customer from you or requesting stuff from you, etc. The second problem, which is I think a more fundamental problem, is that it turns out that then instead of disintermediating for the end client, you're actually adding more intermediaries. Right? The whole point of the whole kind of ethos of the blockchain was to disintermediating, right, the payments and like other products as well. With this, essentially imagine the whole stack of the payment. That is what's happening is that you have an underlying bank, and there is a PSP that works on top of the bank. And there is an on-off-ramp provider that uses that PSP services. And then there is us, essentially. So there's like 3 or 4 companies between the client and the bank, right? And like everyone wants at least 10, 20 bips, 30 bips, sometimes more in between. And it becomes too expensive, right? So then it means that you either have to like not make money on the transaction and just, pass the cost to the client, right? And then make money on something else, or you have to verticalize and you have to actually vertically integrate back to the bank yourself. And that's probably it's probably less important when you are covering only specific corridors that are exotic and, either high risk or capital controlled markets. It's less important. You can still work on this kind of nested solution. But if you want to long-term compete with companies like Wise or Revolut or Airwall, it's not possible. Like you will never be able to compete with them unless you own the infrastructure, unless you internalize the liquidity flows or, own really great relationship with liquidity providers. And I mean, eventually you should be the liquidity provider yourself as the whole business. What is it about? So that's what we realized. It's just too expensive. It's not like long term, you're not competitive. You cannot compete with traditional Web2 fintechs with that model. In order to compete, you need to be a Web2 fintech yourself, but leveraging stablecoin for a more optimal velocity of funds, optimal liquidity management, etc. That's what we realized.
Yeah. And when did you make that pivot?
I would say probably a year ago. I think it was just when we launched 1 year ago officially with our product, with our MVP. And I think as we launched, we started getting the first feedback from the customers on our FX rates, on the pricing, etc. And as that happened, we started replacing some of our infrastructure one by one, country by country, by building closer relationship with banks. We're still in the process. Like we're not in the destination yet, but we're in that process essentially. In important market for us, we are setting up local entities. We're getting local licenses. In some cases, it's money transmitter sort of a license or a PSP license. In some cases, it's more like a VASP registration or a license. And then building relationship directly with banks, building relationship with local liquidity providers, trying to find how can we internalize the flows by working with clients that need to bring money into the country and clients that need to move money out of the country. Actually, we're now optimizing for that infrastructure wherever we see it's important. It's an important corridor for us.
Could you bring that to life? Give me through maybe a real life example of like a specific jurisdiction or country or place that you've had to get licensed, and then what that was like. I think a lot of people are, I mean, the sound of that, I've never gone through that journey personally, but it sounds really hard to go and like get legally papered all over the world and set up these banking relationships and do that. It sounds very difficult. So one, I would love to maybe pick a specific jurisdiction and give a high level of like what that entailed. And then I'd love to know sort of what you're describing in this like inflows and outflows harmony, and an example of a country or a region of the world where you've successfully balanced those flows away, and what that means. Sort of a two-part question there.
Yeah. Let me take the first one first, right? We have just probably a couple of months ago, we received our VASP in Spain, and we selected Spain as our future European MiCA hub. So that's where essentially we're going to be applying for MiCA license soon, and eventually passporting the license across all of the states of the European Union. Yeah, it's not an easy process. Usually it depends on the type of regime and the license you are applying for. Say we started with just simple ones, which is like VASP registrations, which is where it's not technically a license, right? VASP is you just register with a regulator that essentially focuses on AML, right? And what you're saying, you're just registering with them, saying that I'm working in this market. This is the scope of products and services I'm providing, and this is how I'm protecting the customers and assuring compliance of your AML directives, essentially across this country and across Europe overall, right? So I think the hardest part is probably just building up the compliance framework, which is your AML policy, your anti-bribery corruption policy, pretty much your set of documents that define how are you fighting financial crime, how are you protecting customers from different types of fraud and fin crime, and how you're making sure that you're not facilitating illicit funds going through you or money laundering, etc. And then not only doing that, just a matter that you just build the papers, right? But also how do you implement that on your platform, right? How exactly do you do KYC? How exactly do you do wallet screening or transaction monitoring or beneficiary screening? How do you do the risk evaluation of different clients, and what exactly do you do when they're at higher risk or a low or they move between one risk evaluation to another one? What exactly do you do? So it's around building up this and implementing the solutions, and then showing being ready to show the regulator, your clients being ready to show how actually you implemented this. It took us probably 4 or 5 months to do it with Spain. It's also finding the right head of compliance or MLRO who is going to balance between essentially being compliant and maybe sometimes overly risk averse and being pro-business. Because when you're a startup, you need to take a bit more risk. You need to essentially be able to accept more risk than the larger companies do. That's one of your sort of benefits as a startup. And then like finding somebody who understands crypto really well and understands compliance really well is also hard part. So we were lucky to find our MLRO in Spain. She's great. And, she understands, she worked at crypto companies before. She had an exchange and then at a payment company as well. So she had that kind of mix of both the traditional payment compliance experience and also the crypto, the exchange experience, which helped us to build all this whole framework. That's the gist of it. We're now at the process of working on the MiCA license, which is a much harder work because that one is a fully fledged license regime. You need to apply for it, and then it takes sometimes up to 12, 18 months for the full process from building up all the documents, etc. And we're working with our compliance, with local legal advisors that already have experience submitting applications with other VASPs for MiCA. We already had conversations with the regulator to understand their expectations better, to explain them our business model in an informal manner first, so that we can actually work on this license applications in a more informed manner, right? We already understand what they want, what they're looking for, what they can accept, what they wouldn't accept. Like it's just a lot of this balancing between trying to not be too, risk averse for the business, but also not being too risk.
Yeah. I want to go back to that second part of the question, but how do you balance what this sounds like, which is such a big part of the success of your business, with the reality of, in some ways, it has very little to do with the product and the customers and the actual, I feel like obviously there's overlap of the compliance systems and the things you do, but how do you right now balance both of these focus areas? Like, it sounds like this compliance effort, preparing for MiCA registration, getting your Spain license, like that could be someone's full-time focus. It could be your full-time focus. How do you balance that with actually building the product and doing everything that you described before, which is an incredibly complex technical lift?
Yeah, I mean, we just have really strong ops people. I think a lot of them are ex Revolut or Bolt, actually.
Okay.
Ex in ways, and they just have, certain work streams. Like one of our operations people just, entirely focused on everything US related, or like, let's say North America related. So we also have licenses in Canada, and we're applying for money transmitter licenses in the US. So one person focused on that. They also do other stuff as well, but especially they have like that regional scope.
Makes sense.
Work on. And then we also usually have like lawyers that help us. We might have a compliance officer that goes into more detail when it comes to procedures and specific things that we're asking or we checking and the risk levels, etc. But we usually have at least one sort of an ops person that leads that as a project owner, and that's how we do it.
Makes sense. Okay, so going back to the inflows and outflows piece, where give an example of a country or a model where you've set this up in a way that makes a lot of sense. It'd be cool to know what the business that you're working with is doing on the collection side and the other business on the payout side. Just give us an example there.
Yeah, sure. So there are two examples where we had that internalization scenario. I think the recent one is Mexico. We launched Mexico, I think it was September or October. We have a few large clients working with us on the Mexico flow. And yeah, it's simply the following, right? We have a client that uses our Euro IBANs to collect payments from their clients or their partners, essentially, in Europe. So they collect euros and then they need to off-ramp into Mexican pesos. And then we have other clients that need to pay to their suppliers in Europe, and not only in Europe. Sometimes it's just dollar SWIFT, or they need to move money to the US or to Asia, that have the pesos as a funding currency. They give us pesos and they need to do payout into euro, dollar, or Chinese yuan, or say dollar Swift. And then, we essentially internalize this flows within a day, especially if these clients do the transaction same day. There's not much exposure we need to take for local currency, essentially. So the exposure for local currency we take can be for a couple of hours because we can settle. And that's how we do it, essentially. And if you look at generally, I think the biggest sources of inflow and outflow, for outflow, it's usually importers that need to bring stuff into the country, so they pay to overseas suppliers, right? So it can be, importer in Brazil paying for supplies out of China, right? That's a huge part of what we see in the market. And then you have the incoming flow, which can be NGOs paying to the beneficiaries in this market. It can be sort of a payroll to contractors in the market. Let's say you have contractors in Bangladesh and you're paying to them. It can be like somebody like Uber or Bolt paying to their drivers in that market in Kenya or in Nigeria. Or it can be simply remittances flows from, essentially, let's say a Nigerian in the US sending money back home. That can be also so. And then if you can internalize this flows, that's where you can make more of the FX spread, essentially, right? And not rely on the external market maker that much.
Does that cause you to, when you grow, focus on geographies sort of in a one-by-one sequential manner? Like you kind of laser in on a single geography and stand that up and get that machine going and then move to the next one? Or do you sort of, like, how do you approach growth in that sense? I'd imagine it's sort of a intentional process.
Yeah, so let's say the two parts. When it comes to launching a new market, for us, there are like two ways you can launch a market, right? One is just what we call connectivity. Do we have connectivity in this market? It means, can we collect payments in this market? And can we pay out into this market with local rails and also dollars or euros, right? That's one. I think for the connectivity part, we're trying to grow as fast as we can, right? So we're trying to get access to all the payment rails across the world and be at 120 countries plus, local currency, local payment networks as soon as possible. And we're currently at, I think, 85 markets for local payments and then 150 markets with Swift payments. That's one part of it. But then there is a second part, which is more like a GTM focus. Where do you go after clients? Where do you do the distribution? That part is a bit more bottlenecked. We cannot launch simultaneously in all the markets. And when we are trying to be more, purposeful and like really analyze which markets are more interesting for us. And historically, we were mostly focused on, emerging markets. Specifically, we're focused on some of the major countries in Africa and Latin America. In Latin America, it's pretty much 4 markets that are interesting for us. It's Colombia, Mexico, Argentina, and Brazil. And in Africa, especially Sub-Saharan Africa, it's pretty much Nigeria, South Africa, Kenya, Ghana, and then there's this we call a francophone region with ZOF currency, like Cote d'Ivoire, Cameroon, Senegal, etc. So this is how we kind of look, and these are some of the markets where we see a lot of demand. We see interest from businesses and not only businesses but also individuals in this market. We targeting this market, and then over time we're going to be expanding to more and more geographies in terms of go-to-market, hiring GMs and salespeople in this market, and doing PR, marketing, local content, partnerships, etc.
So with stablecoins, right? What's the stablecoin podcast? How would you simplify the way that stablecoins play a role in this flow? And sort of tacking on to that question, what about that is competitive and unique to what you might be building against a company like Wise or AirWallex? And give us the overview of how stablecoins come into play here.
Yeah, sure. I think short term, what stablecoins give us is, I'll say 2 things. One is there is a bit of an arbitrage, regulatory arbitrage, where stablecoins allow us to enter markets faster. And given that a lot of the countries don't have crypto regulation yet, it allows you to actually enter the market much faster, use stablecoin as the vehicle for exchange or for vehicle of settlement. So it kind of allows us to bootstrap our growth with less resources and less kind of effort, and then get very close to the similar network size that Wise and AirWallex and others have without having to have like the same amount of licenses. Even though that's changing, as I said, a lot of the markets come up with new regulations. So you need to get licenses. Longer term, that arbitrage or that sort of thing will vanish and you will have to have licenses anyways, right? But short term, that's good. Second thing where stablecoins are good, the second reason why they are beneficial to us is they allow us to have less of liquidity requirement for the same spec of the settlement time. Like if we're saying to a client, all the transactions below X are instant, right? For somebody like Wise, it means they need to either have internalized flows, so they need to have other flows coming in and out within that time period. They can internalize. You don't need to go out and buy the currency. Or it means that you need to have your own liquidity that you use to facilitate the settlement time to be instant, right? And what stablecoins allow us to do, and it's not all stablecoins, it's actually stablecoins and it's real-time payment, local RTP networks that make this possible, is that I can rebalance my liquidity across accounts pretty fast within 30 minutes in most of the cases. Why is that? Is because if I have like too much of, and I need to buy stablecoins because somewhere else I don't have enough stablecoins, what I can do, I can actually use the local SPAY, which is like a instant payment rails, sell this pesos and get USDC instantly. With traditional rails, you would have to use, especially Swift to actually get this money out of the country and then rebalance your liquidity somewhere else. Or you would either have to get a loan or a revolving facility to have that dollar somewhere else for that. So that cost of liquidity goes down because I don't need that much liquidity in place at any moment in time. I can actually buy and sell pretty easily. And another thing is the velocity is higher. I can actually turn over more funds because the settlement time is faster, even within my own network. I can do the same amount like 10 times a day, and I don't have to take FX exposure for the whole day. If I take the FX exposure for the whole day, I'm going to also mark up for the whole day. I'm going to put like let's say 60 bips markup because I don't want to take too much of peso exposure, right? So I'm going to add 60 bips to the cost. But with stablecoins, I can put 30 bips or maybe 20 bips or eventually even lower than that. I think these are two reasons: the liquidity needs and then the regulation requirement. This is what stablecoins allows you to do.
Yeah, it's exciting. I know we're coming close here on time. We can start wrapping up. This has been really great. When you think about this year and what sounds like a year that you've been, last year was really building, launching, pivoting some things, getting some foundational regulatory stuff set up. I'm imagining growing the team, hiring. I'd imagine there's some exciting stuff for you as you think about this year. What are some things that the listener base should be on the lookout for that you're excited about?
Yeah, I mean, I think so this year is like the building never stops, right? You always build, even when you're already out in the market. So we're going to continue building more. And I think on the building side, we're going to continue building the infrastructure, getting better and more reliable rails as we go across more and more countries. And it's important also having both, ability to collect payments, but also pay out in each market, having virtual accounts or similar in each of the markets. So we want to have that set up in most of the markets that we present. That's kind of on the infrastructural and baseline level. But I think what's important this year is we're going to be much more aggressive on the GTM side and like distribution side. And we want to break out this year. And we're spending much more resources on both hiring people locally that can sell our product locally or market our product locally. And we're going to be investing more in things like content. We're going to be investing more on the application layer because I think previous years we were investing more on the infrastructure layer. We're going to be investing more on the application layer, adding new features that can be interesting for customers, businesses, and individuals over time. So we're going to be adding things like cards. We're going to be adding things like team access, which we didn't have before. We're going to be adding things like yield assets and yield-bearing assets and savings account, whatever you call it. We sort of want to build that full experience like you have with Wise and Revolut of the world, fully on chain, right? And that's what we've been building. And this year is going to be even more, explicit, I would say.
It's exciting. I'm excited to see a lot of that come to life, and I'll be following along virtually from here. I know you're in London. I'm in the US. Do you come to the US every now and then? Or you pretty much posted up there?
No, actually, I was in New York pretty much 2 weeks ago. I love New York. New York energy is amazing. So I come there probably a couple of times a year, 2 or 3 times a year. I'm going to be in LA and SF in March. So 1st March, I'm actually going to be there. So if you're there, anywhere there, like we can catch up.
Cool. What are maybe final thoughts before we part ways? What is maybe one big takeaway for the listeners before we go when it comes to Do and what you're building?
I think from my perspective, I mean, we know that there's more and more competition these days, right? Like there's a lot of new startups that are building on stablecoin rails and like trying to tackle the same problem. I believe this is a survival game, right? You need to survive. You need to build a viable, business, viable moat. I think the key takeaway from us is that we're here for the long term, right? We want to build an infrastructure that is as reliable and even more reliable, as fast and as seamless as Wise is today or Revolut is today, or even more than that, right? It requires a lot of work. It's not one iteration. It actually takes multiple iterations. It takes a long time to polish and refactor, but we all for it. We understand the complexities of, regulation, infrastructure, bank relationship, and the GTM, which is, I think, the hardest part, right? We understand this, but we're happy to take on that challenge. And I think this is why it's exciting, right? It's hard in ways. That's why it's interesting. If it wasn't hard, if it was easy, somebody else would have already done all of that. And it wouldn't be interesting for us to even, do it. If at some point we realize these problems are already solved and somebody's doing it better than us, it means we're not needed. But I think so far, there's still a lot of friction. There's still a lot of, inefficiencies in the payments, in the global payments space. So we're here to stay and we're here to win.
It's exciting to follow the journey from afar. And thank you for the time. And we'll have to connect again soon later this year.
Yeah. Thank you, Drew. Cheers.
Cheers.
Thanks very much.